Hey guys, welcome to the webinar. Looks like we have everyone on. I want to invite my guest, Matthew Green. You want to introduce yourself?
Hi guys. My name is Matthew Green. Ron, Ron and I both attended Cornell, which was the foundation of our real estate education, and we are both real estate practitioners here in Dallas. I came down here about 3 years ago and have been primarily focused on the multifamily sector.
Okay, awesome. So the general outline for today is we prepared a pretty short overview PowerPoint. It's about 6 pages long. And what we'd like to do is talk through that PowerPoint and then open it up to Q&A. So I see a lot of you guys are here on video, which is great. So feel free to unmute and just chime in with questions at the end. But we're really hoping this to be a little bit interactive and answer your guys' specific questions about distressed real estate, multifamily in particular. That's right up Matt's alley. We're going to talk a little bit about financing. We're going to be talking about underwriting, the models, and really what this chaos is producing in terms of opportunity. So let me see if I'm able to, oh yeah, and feel free to use chat. I think if people have that chat feature, you can go ahead and message there. We'll also take questions there if you're in a noisy environment. So let me get started. All right, so again, distressed real estate with Ron Rohde and Matthew Green. Here's a little bit of the background. I'm an attorney. I'm also personally an investor. I think that really gives me a unique experience to know what that risk-reward ratio looks like, and I'm able to help counsel my clients on pulling the trigger and making good business decisions. Matt?
Yeah, and as I said, I've been here in Dallas for multifamily for a couple of years. By trade, I'm mostly an acquisitions practitioner. I have done that earlier in my career in New York City with triple net lease REITs with W.P. Carey, and then briefly in Cincinnati, Ohio as well before I went to Cornell for MBA. And then after MBA, came down here to Dallas. I worked with a Presidium Group for about 2 years. Presidium is a value-add multifamily investor and developer here. So I did things on both sides of that. And then the past year, I've been at a firm called InvestRes, where I've been primarily focused on asset management and dispositions.
Great. All right, so let's talk about purchasing a distressed commercial property. What do we largely define as a distressed asset? Matt, you want to go with it? What's your definition?
And in truth, it is a very, very broad swath of a definition, but in general, it can be defined as something where you have a much lower basis than you would, but really what differentiates it the most is that it is in a unconventional market situation whereby there's some external force being exerted on the market to push asset prices down. It can happen in two ways. I mean, individual assets, even in a good funding environment, in good capital markets environment, can become distressed. Say if it's an office building, has 3 tenants and 2 tenants move out at the same time. That potentially could be a distressed situation if that was not properly managed by the owner. Then you also have situations where the capital markets are haywire, as is going on right now, as what happened in 2008. And that is what I would call an underfinanced asset. And then usually those are the two conditions which are the hallmarks of a distressed asset. The best combination is both, but you can have one or the other.
Great. Yeah, and I think you kind of touched on it. There are unique circumstances that it could impact a motivated seller. And whether that's a lot of sellers simultaneously, that's market conditions, versus individual sellers, they usually feel the crunch sooner versus other people, right? It's not a uniform deal. Every seller feels some stress at the same time. There are leading sellers who are over-leveraged or poorly managed, and they might present an opportunity. So again, why buy a distressed property? It makes sense. The seller is motivated to sell due to some factors or some conditions in their finances or their market, lower basis and significant upside. Again, I think those all make sense. I'll speak a little bit on this. What do I need? So if you're an investor here that's on the call today and saying, hey, I've been traditionally buying, occupied or value add, quote, regular properties. What's the difference that I would say with a distressed asset? And in my experience, when I've advised my clients through this, speed is really important. So being able to close quickly really helps sweeten your deal. And maybe that seller is willing to take more of a haircut if they can close faster. And what that means is you need to have your own investment goals. You need to be able to underwrite very quickly, just on back of the envelope, does this deal pencil for me quickly? And you got to be able to run the numbers, understand what your unique strengths are. What do you bring to this market? What do you bring to the asset? And then finally, identify your team. So figure out who is going to be your banker, who is going to be your lawyer, who's going to provide your inspections, who's going to do your engineering, property management, maybe you have a new marketing plan, right? I mean, I think we talk about that later, is the perception of a building in the local community is so important. It can be worth a few $100s in rent every month, multiplied by hundreds of units. It can be quite tremendous. So finally, closing and operation. So these are some of the next steps. And for people that say, this is interesting to me, I didn't want to pay $110,000 or $130,000 per door. Here's your opportunity. You're getting your discount. You have to buy in this market. So
I might also add briefly there, if you're talking about, having the ability to do a halfway decent underwriting with very, very little due diligence materials, the epitome of a distressed asset is one that you march up to the courthouse steps and get at auction. And often those are going to have very, very little in terms of rent rolls, in terms of profit and loss statements, et cetera.
But you do have, other public resources that you can do investigation, beforehand, right? So I agree, that's the epitome of a short sale. But at the same time, you do have tools available from county records. What they put online, if they had online reservations, you can get a sense of what kind of marketing they were doing. You have good rule of thumb that says, hey, for a low-rise 3-story apartment, something like that, what their operating margins are going to be roughly. What their price per foot is going to generate in revenue, bound high and low pricing. So I think it's really interesting that, yes, you don't have it provided from the seller, but you still have a lot of resources to estimate as a rule of thumb what you can be. So here, we go through a lot of issues. And again, I don't want to just read this PowerPoint. I'm happy to share this with you guys afterwards, and we're going to email it out. If you're on the webinar and you didn't RSVP with me, feel free to drop your email in the chat box or direct message it to me, and I'll be sure you get a copy of the PowerPoint. But these are really some tricks of the trade. Matt, I think you taught me this one. Look at their budget. See if they're budgeting $300 a unit on CapEx, but then in the last 6 months or 12 months, they've only spent $100. Why is that? And if you can come up with the answer to that solution, you can see areas that you should set aside part of your budget to re-spend or reinvest into that kind of deferred maintenance. But it gives you some insight, so you don't really know where you're chasing these funds. Are you spending it on the roof? Are you spending on electrical or plumbing or landscaping or foundation? You can see it in their budget. So Matt, you want to jump in one of those?
Yeah, so one other area there too is always make sure whether it's your reserves, your replacement reserves, which is generally 250 per unit per year. You want to be able to give yourself a buffer in there. That is for the unexpected. I mean, that is for your insurance comes back. Lloyd's of London says we can bid on this, we can insure this. for 405 a unit when you had budgeted 350 and you're under contract. Well, that's where having a little bit of buffer and some capacity there really comes in handy. Another area where that happens, and this has been happening at the end of the market here, as the market really started to get frothy in DFW in 2017, 2018, one thing we saw increasingly was the municipalities got very, very, very aggressive on tax assessments. So be sure to have it assessed, and then also be sure to have a very, very good attorney to do your appeal for you. Usually it comes out to about 85 or 90%, but you definitely do not want to underwrite, assume it's going to be 80% of the appraisal. One other thing, and then this is something which actually blew up a deal recently that I was working on, was there was a property in the Vickery Meadows submarket of Dallas called Easttown. A local private equity firm here was under contract for it. My firm was slated to do the management for it, so we did all the due diligence for them. So we just did a standard, charge them $50, or sorry, we charged them $500 per unit for due diligence. But then what ended up happening was due diligence uncovered a number of unanticipated issues. They had Federal Pacific breakers and they had copper wiring. So that was one big thing, and that was one thing that had not been represented by either the broker or the seller. That was going to be several thousand per unit to take care of. The roofs were in worse shape than we thought, but the big thing actually came long after due diligence and actually several weeks out of closing. And that was, this particular property did not have a very good reputation as a good place to live. It was, lots of complaints to the city of Dallas by residents. The previous owner was actually out of Beverly Hills. They did not even have a regional manager, like property manager in Dallas, trying to someone local who could manage it. They were managing it from Los Angeles, which is a recipe for disaster. But the point is, they paid very little attention to it. And the city of Dallas had a laundry list of things that they needed to do on top of what we were recommending that we had uncovered in our normal due diligence. Think things like resurfacing much of the parking lot, things that we had not just anticipated, redoing the drainage on a lot of parts of the property. So long story short, that was going to add another 100,000 or so in CapEx. And I think that was the straw that broke the camel's back for my client.
Yeah. So for these distressed properties that we're looking at, say this summer, would you want to avoid something like that? Because, that's a worst case scenario in a good market. What's the worst case scenario in a bad market? You can avoid those deals, right?
You can, because oftentimes a lot of properties, again, this goes to properties that are simply undermanaged. Often they have good bones, as you would say. There's nothing intrinsically wrong with them physically. It's just that the owner overpaid. Gotcha. And you're going to see a lot of that probably in the next couple of years, because that's what I saw literally nonstop since I moved here.
Yeah, absolutely. Okay. So we'll talk about this a little bit. Where to identify a pipeline of leads? I have it broken down a little bit. We have lenders, we have brokers, we have the principals, special servicers, where if a property if it's late or misses a mortgage, it might get transferred within the bank. But really, I come across these. I have my clients. I'm always curious. I ask my clients, where did you get this deal? Because it's going a little bit sideways, but it's not quite there. To where I would say, bank owned. That's basically the last ditch, right? Maybe a tax auction would be last ditch, right? If the bank doesn't even want to pay property taxes on it and just kind of gives it up. But, I think it's important to understand where you're getting your leads and who is giving them to you. Because if you're getting them directly, say from a principal, it might be a single group or a single GP that says, hey, we're real over leveraged on all of our properties. We've got 8 or 10, properties. We're feeling a little bit of stress. We're concerned. We would trade some equity or haircut to get it off of our plate, to get that debt service off so we can focus on more core properties. Maybe they're based down in Houston and they've got 2 or 3 up in Dallas, but they might be wanting to shed those 2 properties in Dallas to focus on Houston, for example. And again, it's really about identifying where is your lead coming from, what's their motivation to sell. And if you can understand where the seller is coming from, you can get a voluntary transfer that is a win-win, so to speak. They're nervous. They want to shed some of this debt. They want to shed some of this headache. And they'll take an equity haircut. Are they going to give it for you a fire sale? No. But we're still, I think, in the very early stages of this COVID-19 pandemic impacts to real estate, right? We may not even be there at all. We're not even in a stage, I would say, right now. But the next stage will be a couple of people who are over levered, the people that had a very unique sweet spot or a perfect storm. I think Matt and I talked about this. I really am seeing COVID-19 as a very, very unique combination of events that is unlike any other normal recession. And what I mean by that is people are losing their jobs immediately. It is not a case of the service providers cutting back the hours. People are going to Starbucks less and less, and that would reduce their hours that they're working and their pay, and then their rent gets a little bit tight and they're a little bit late one month and then they miss the next month. That is, quote, like a normal recession. What we're seeing here is for multifamily, people are losing their jobs. They're getting hours cut to 0. And while they might get a stimulus check, that might help them out for 1 month. That doesn't solve their problem for May 1st. And it's this catch-22 as well, where all the courts are shut down, unrelated to the recession. And when the courts are shut down, the evictions are stayed 60 days, right? You can't evict anybody. And I'm not even going to talk about forbearance of a mortgage payment to, agree not to evict. I'm talking about a complete stagnation where if you have a property that's 90% physically occupied, economic occupancy may only be 50%. You're in a very bad place because you can't evict people, and yet they can't pay rent. And it's really happening really suddenly, so that if you don't have capital reserves, you're not going to be able to make your mortgage payments. You're not going to be able to pay all of the expenses associated with managing your property. And so I think while we're not seeing sellers distressed yet, when it does come on, it will come on very suddenly. And there will be a lot of properties on the market because they have tenants that every single tenant can't pay their rent. They got their hours cut so dramatically. It wasn't a gradual decline. Matt, what do you think about that?
Yeah, I mean, it's interesting, whether you're looking on LinkedIn or, any other forum where, economic commentary is given. People are, I think part of it too is a lot of people are at home, so they have more time to have these kind of discussions. But, everyone seems to be wanting to look for answers or provide answers. And it seems so long ago that we all started working from home. And yet, you have to consider, like, April 1st was yesterday. Like, landlords just had their first taste of what it's going to be like in terms of seeing people not paying their rent. And Ron, hit the nail on the head in saying, this is probably just a harbinger of what's coming next month. It's probably not going to be as bad. I would say that, let's just take a step back from just multifamily and say, what landlords need to remember and what real estate investors need to remember, though, is just everything is negotiable unless it is overridden by law. So Ron mentioned, the moratorium on evictions. That is something which overrides your ability to negotiate with your tenants. Now, actually, you can negotiate with your tenants in good faith to maybe, have a reduction of lease payments, for something, but, you can always modify the lease, but what you can't do is evict them. That part is off the table. People just need to, I think this is going to be a couple months, really, let's say a year, just where a lot lenders, like all the stakeholders, lenders, landlords, tenants are just going to have to get to the negotiating table and hash things out and learn to be reasonable. because, maybe not so much in the case of multifamily, but take an office building with only a few tenants. I mean, it's not in the lender's interest. It's certainly not in the tenant's interest, and certainly not in the landlord's interest for someone just to lose that lease because one party or another is not willing to give some ground. It needs to be very much be, uh, quid pro quo. I give you something, you give me something, and they should be prepared to do that. The flip side of the coin, of course, is that, especially in multifamily, there are bad tenants out there, and there are bad tenants in any business, but there are bad tenants who are going to take advantage of this. And that's the downside for a lot of landlords, is people who could pay are just simply going to choose not to because they know that they can get away with it. So that's my take on that.
Yeah. And that's where we can come up with some creative solutions, to reposition the distribution of tenants. There are ways to get the property, producing more net income with maybe a higher capacity. I know we've talked about that before, but, follow up with us if you're interested in some of those strategies, because they're very creative and they don't involve, judicial remedy. They don't involve the constable. They don't involve tossing people out on their heads. I'm going to go through some of the legal topics. This is just really quick. I know that everybody on here is sophisticated. They've done deals, but we're going to talk about the LOI, the letter of interest that goes into a PSA. Normally, maybe you have 10 days to negotiate, but in this truncated, distressed acquisition, you might be expected to go from signed LOI to a signed PSA in 3 days. Because again, every day matters. And if they can close before the next mortgage payment and preserve their credit and preserve everything, that's going to be in the seller's best interest. Once you get that PSA, you go into due diligence phase. Again, everything is like warp speed. You're going to get some due diligence. You're going to want some feasibility period, but these are fast times. If you want to move quickly and take advantage of a stressed seller, you're going to want a 15-day due diligence. And can you review everything in 15 days? No. I'll just tell you straight up, no. But you can perform a triage and identify the biggest cost areas, the biggest physical plant areas that are going to cost money, and do what is important for you to close. And it's not going to review everything, but you're going to get the major issues. And then finally close. And I would say on a normal scenario, you might be looking at 60 days, 75 days from step 1 to step 4. In this type of distressed market, we're looking at 30 days, right? I mean, we can go from LOI to close. If you have your financing ready, the fastest some of these lenders can close would be maybe 30 days.
Yeah, just about.
Yeah. And some of the things that we can do, as your lawyer, is to write in additional seller reps. And especially if they're pulling out any equity in the deal, we want to try to put that in escrow. Unless they need that money for something, we want to hold back as much as we can, so that if there are undisclosed liabilities or undisclosed costs, contingent issues, we have some escrow holdback. And that's really the only tool you're going to have as recourse for taking title in such a short period. If you can put a few $100,000 in escrow, that could soften the blow if you discover something down the road. And we can talk about that later. Feel free to email or reach out to me for those issues. Financing, again, I think we've talked about it. Good debt's a powerful tool. Bad debt can kill you. And I think the people who we are buying from will fall into that last category, and they realize how a 90% LTV doesn't quite work if you don't have the cash flow. But then you can still use good debt. There will be lenders putting out money. Again, you might be at 60% LTV, 50% LTV, but that's still debt. That's still a good chunk of your capital that's helping close the deal.
Yeah.
Do you want to?
Might also, or you go ahead, Ron. Sorry.
No, you go ahead.
Okay. So another aspect of bad debt, always use non-recourse financing. Do not ever be enticed to pledge any of your personal assets, and that is what non-recourse financing is.
Yeah, and definitely, again, I don't want to go too much into the weeds, but like different agency products, they're paused right now. Is that correct? They're not lending, or are they?
So they're more focused on Fannie and Freddie are going to be so backed up the next couple months, just getting all these forbearance programs into place. I mean, I think it's not as much lender driven as it is that buyers have all kind of stepped back.
Right.
I think it's a function of less demand right now.
Gotcha. Yeah. So I think that's true that, but again, build those relationships now. I think the more organized you are in terms of having your LLC ready, having a draft LOI that outlines roughly what you would do, what would it take for you to close on a deal, having that ready and having your team, for the financial, the modeling, the underwriting ready, have your lawyer ready, have your banker prepped, then say, hey, we have capital. We are ready to look. And when the blood starts to spill, this is our metrics, this is our underwriting. Once you get a deal across your desk that fits that, you'll be ready to pull the trigger quickly, because that's what it takes, and if you're not poised to act quickly on a deal that fits your metrics, somebody else will. Because I can tell you, a lot of my clients have been putting out LOIs and putting out offers and just saying, I can't buy this. I can't pay $95,000 a door in Denton County. I just can't. And yet other people were buying it, maybe more on the LP, the syndicate sides, the Facebook crowdfunding, people were buying them. But if you stick to your metrics, you stick to your underwriting, that still holds true in a recession or in a contraction type environment. But you still need to act quickly, because I'll tell you, there is a lot of capital on the sidelines that has tempered themselves, and they have not overpaid and not bought into the the kind of the Ponzi scheme of just, well, I can buy it for 100 because I'll sell it to somebody else for 130. Finally, that music stopped and that free money stopped flowing. But on the reverse, there are people that are waiting to buy. And so if you're well capitalized and again, manage your asset well, and you'll be okay.
I might also add that the lender relationships and the broker relationships. I mean, this is your chance to really make a name for yourself. And if you make a good name for yourself in the broker community, you will get more opportunities than you can imagine in times like these, because both from my time in New York and my time in Dallas, I've talked to senior brokers who are always trying, and I've heard this literally verbatim from guys in different parts of the country. They say, in the good times, I always try to tell the young guys in my group, making the money as a broker is the easy part. It's holding on to it. That's tough, because there will be years that are very, very slow. We're entering into one of those years right now. Guys in Dallas I've talked to, were recalling 2008, 2009, where they did one deal in 2 years, and they had their own brokerage group. So, the way you can endear yourself is, when you get an opportunity, be able to execute and be able to close in a tougher market environment. That will really, really endear yourself to brokers. And then when the market recovers, you can guarantee that you will be one of their first calls when opportunities come up as well.
Yeah, absolutely. I mean, I think that's really true, is develop a niche. If you want to invest in distressed assets, have a very clear game plan, be ready to execute when something comes across your plate, and capital is not going to be the problem. There are so many people searching for yield. And I think especially now with T-bills basically, down to zero, there are people who have investments as their primary income. These are individuals, high net worth individuals, that are desperate for yield. They cannot get it from the stock market. They don't necessarily want to manage even a single tenant triple net investment themselves, but they are desperate for yield, and you are providing them the opportunity for their livelihood. I mean, it's their income that they rely on. And that's what I'm hearing from people that are saying, hey, Ron, do you know of any good deals? You're really providing a service to the people. So again, don't think that capital is your limiting factor. If you get good at this, people will give you capital, people will give you deals. And I hope this has been educational and you guys can take away something. Here, I'm throwing up our emails. Matt's email is up here, my email. Feel free to reach out. And I have a list of everybody that responded earlier. So I'll go ahead and share this, directly from the email. But other than that, does anybody have any questions? You guys can just hop off mute and
I have a quick question. With regarding the due diligence period, and I understand you're with distressed properties, you're dealing with the tight timeline, but what do you think are the implications of assuming the shelter in place lasts for a while? I know a lot of I spoke with a broker the other day who said, oh, that's not going to have an impact because everyone's just going to be fine with like a virtual tour. So do you foresee like just kind of the immobility, not being able to walk the property yourself or see the units will impact one's ability to buy a distressed property?
Yeah, well, admittedly, I'm guilty of this. I mean, I've been, as a real estate practitioner, I drive around a lot. I've been doing that, just not getting out of my car. But yes, it will be impossible to do the degree of on the ground on the property, in unit, walk-in units, and see the boilers. Everything you really want to do in true due diligence is virtually impossible right now. But I haven't really thought about this, and Ron, maybe you can chime in on this, but I think real estate has been declared an essential business in many jurisdictions throughout the country. So I don't know how that would necessarily apply to your ability to do due diligence on an apartment. My guess is they would want to, because especially doing in-unit walks where you have a team literally walk every single unit, because you can have different levels of upgrades, and you want to be able to determine, okay, this one is one of 20 combinations, so I think I can raise rent on this one this much, and then other combinations of renovations. You want to get sort of a more uniform product so you can have a more predictable rent levels and cash flow throughout. But yeah, to be able to, particularly in unit walks, would be next to impossible, I would think.
we have some music entertainment. Does anyone have any other questions? I think that's a good question for every state. Texas declared real estate as essential. So.
Yeah. Hey guys, this is Niels. I probably have a question for Matt. What do you think? How do you think the asset prices are going to be affected over the next few years for multifamily? I mean, I think when we think about hospitality and COVID, I mean, it's probably going to look like more of a V-shaped curve with demand spiking up, once COVID has gone away. But in the multifamily space, I think, I would be surprised if multifamily owners see any rent growth over the next kind of 1 to 2 years, given that, your average blue collar worker isn't going to be paying their rent payment.
I think there's a couple considerations. I will try not to be too long-winded on this, but a few thoughts. So one, compare real estate investing to your traditional leverage buyout of of any company, where their cash flow, whether they produce something where their cash flow is continuously coming in, as they sell their product. But if it's an industrial company, for example, I mean, they're likely shut down because they're not an essential business. In as early as the second week of February, I think, Carlyle, Texas Pacific Group, Blackstone, all big private equity firms worldwide were telling all their worldwide portfolio companies to fully draw down your revolvers and raise cash, because you're not going to have that cash flow. Those are going to be the ones who have the biggest haircut, because they're not essential. They're not producing food. They're not shelter or any basic human need. A lot of them. Those are the ones you're going to see the most affected by this. That said, though, as for values within real estate, I mean, looking at cap rates already since the beginning of February, I saw last week, and this was data through the second week of March, I think. Real Capital Analytics had identified, as you might expect, that hospitality has seen the biggest increase in cap rates. They've already seen 324 basis points of increase, or like 3.24%, which is absolutely huge. The least cap rate expansion has been in, I think, cell towers, data centers. Multifamily was one of the better performers with only 73 basis point cap rate expansion, which is less than a percentage point. But, you know, this market cycle has seen, you know, for B and C properties in Dallas-Fort Worth, for example, you saw those at 8-9% back in 2010, and they're down to like often 5% now. You're probably going to, I would want to see expansion up until, you know, 7% maybe before I would be comfortable as an investor with many, many deals. But yes, so multifamily, based on the evidence so far, I think what we're already seeing is what you might expect. Hospitality, yes, V-shaped recovery for sure, because it's driven by are people conducting business at the end of the day? Like, are people going on vacation? And then, you know, multifamily obviously is where people live. So I think, to answer your question, I think, you know, if we had a cap rate expansion of, 200 basis points nationwide, that would equate to maybe about anywhere from a 15 to 20% fall in values. But again, who knows yet? You know, we don't know what's going to happen here.
Yeah, that's definitely a good point. Is we have this call and we just see that is going to be some distress, that it's not going to be zero, but we haven't seen the full extent. You know, I think the news and the pundits are still saying it's going to get worse before it gets better. FEMA just, ordered another 100,000 body bags. And I say that, and it's not meant to poke light at it, but this is a very serious situation. We haven't really seen the full ramification, and in real estate, those effects are going to lag behind the real world events. And so, 2008 or 9/11, right? That might be a more apt comparison. Things didn't stop trading on September 15th. It really took until a few months that people's pessimism, people have different outlook. They weren't expanding. They weren't signing leases. That's what this kind of COVID effect will be, is a general temper and a shift. It is going to cause some people to be more conservative for the foreseeable future. So,
to Ron's point too, one last thing here is, and to see an idea about how this will play out, there's a wonderful service. Is people here familiar with the TREP? TREPP. They are a reporting service for all commercial loans, and think of it as like a CoStar or like a RealPage for just commercial real estate loans. So you can literally see when a lender puts a loan on watch. So that will be watching that data very, very intently over the next year will give us an idea of, what sectors are having a hard time servicing their debt, what geographies it's happening in, and again, in what sectors and what subsectors. So, and then of course, with what types of financing instruments, what types of debt instruments were put on those investments. So again, very much TBD, but we'll be watching the TREP tapes intently.
Sorry, how do you spell that? TREP?
TREPP.
Thank you.
Yep.
Just to follow up, so Matthew, you do feel that I mean it's anyone's guess now, and as Ron said, we're still in the early developments, but you do anticipate a rise in cap rates, like you were saying in Dallas, Fort Worth. Things are in the 5 cap range, and they could go up to like the 7 cap range, at least before you'd feel comfortable to make an acquisition.
Nationwide, we saw about 200 basis point cap rate expansion from 2000 to 2002 or so. That was not for single family homes. As you know, single family homes were doing very, very well during that time, but certain multifamily in certain sectors, certain areas of the country, like the Bay Area, which was very affected by the tech bubble. And then from 2008 to 2010, we saw roughly the same. But again, 200 basis points, can mean, in New York, if you're in New York and Los Angeles, for example, very, primary markets where, certain sovereign wealth funds, for example, international sovereign wealth funds, their mandate is to invest in U.S. real estate, but they'll only focus on primary markets like New York, LA. So that, there's more demand that will put cap rates down there. From 2008 to 10, we saw, maybe cap rates go from 4% to 5%, which is a 20% increase. Whereas in Texas, you may have seen 7% to 9%, but that's not as much of a hit property or in terms of value wise, or in terms of value. So again, your value, of course, is your NOI divided by the cap rate. So every property is going to be different. But nationwide, yes, I think because this likely will lead to a degree of credit distress, which of course will affect all lending, then, and on top of that too, you have a lot of buyers who are going to wait on the sidelines, because once that momentum starts to the downside, people don't want to be the first to try and catch a falling knife. A lot of the times you want to wait until you feel like it's really hit the fan. And I mean, yeah, again, and remember, like, we're literally at the beginning of this. People just, stayed home 3-4 weeks ago. But yeah, in Texas, I mean, this has been an incredible run this past decade. I think that if cap rates go up to 7%, I say that because, the nadir of the last market cycle, the market trough was 9 to 10% for B and C. And so I would think the way that, especially the dynamics in Texas, at least, where there's going to be more people moving in here, it's starting to have more aspects of a primary market. I think we would have a lower peak on that, so to speak.
Yeah,
if that makes sense.
And Matthew warned me he didn't want to go into the weeds on financing too much, but it's definitely very interesting. I think, for our people today, we can point them towards some tools. We're big fans of ACRE. There's some great calculators. You can plug in a lot of numbers that give you your back of the envelope, one tab calculators, right? So this is a financial modeling that's all contained on one Excel sheet. One tab is really nice, including all your inputs and all your outputs on one tab, things like that. I have free PSA, LOI forms. Feel free to reach out. I share those. But unless there's more questions, I'm going to let people get back to their lives. And thanks to Matt for joining. Thank you to everyone for spending your afternoon with us. And be sure to look for more content. This is a rapidly evolving area, and hopefully I'm going to keep it focused on distressed real estate and what our clients and what, Matt and I are seeing in the market. Because again, we talk to those brokers, and I'll tell you, everybody is nervous and is sharing their comments with us. So.
Thanks, guys.
All righty.
All right, guys.